Hello everyone, welcome to our today's lesson. Today I would want us to look at variances, and specifically I would want us to do this question that is on our screen, right? So it reads, Q Limited manufactures a single product branded Q. The standard selling price and variable cost per unit of product Q are as follows. So we have the selling price, we have materials, we have labor. Additional information, the budgeted sales for the month of October 2015 were 38,000 units. The actual results for the month of October 2015 were as follows. I can see the production and sales. I can see selling price per unit. I can see materials. I can see labor. I can see the company is operating a standard costing system and a just-in-time system and a production system. Required, showing applicable variances, prepare a statement that reconciles the budgeted contribution with the actual contribution for the month of October 2015. For the month of October 2015. Now, ladies and gentlemen, for me to be able to compute variances, I need two things. I need the standard cost card, and I need the actual results. Remember, for us to get any variance, you will always be taking the standard parameters minus the actual parameters. To get any variance, you will be taking the standard minus what here? Actual. Standard, what you planned, minus in this case here, the actual. What you planned minus the actual. So ladies and gentlemen, which types of variances am I going to compute here? I can see there is a selling price. So sales variances are very important. I can see material. I can see labor. So I'll compute sales variances, material cost variances, and the labor variances. Let us begin with the material variances. So material cost variances. Material cost variances. So please, for those of you who are online, try sharing this video on your timelines. When you share, you will straight away be inviting your friends to study with us. You'll be inviting your friends to study with us. So there are two types of material cost variances. There are two types of material cost variances. Number one, we have what we call the material price variance, abbreviated as MPV. And then number two, we have the material usage variance, abbreviated as MUV. So I would want us to study how do we compute this material price variance. Ladies and gentlemen, it's a price variation. We have got two types of prices, remember. We have the standard price, what we had set that we would have incurred to procure our raw materials. So we have the standard price minus, in this case here, the actual price. So the standard price minus the price that was actually incurred in purchasing our raw materials times our actual what here, quantity that we did what? That we purchased. So this SP stands for standard price per kilogram. Standard price per what here? Per kilogram. Have they given us the standard price per kilogram in this question? If you look at this question very well, we have the standard card here, where they have given us materials 2 kilograms at shillings 10 per kilogram, which gives us 20 here for our whole unit. But you see, I want the standard material price per kilogram. So it is 10 per kilogram. So this is 10. And then we have, in this case here, AP, what does AP stand for? This is actual price, again, per what here? Per kilogram. So if you look at our actual price here, if you look at our actual price in our paper, the actual price is here. Actual information is in note number 2. The actual information is not in note number 2. So the actual results, so you can see under actual results, we have materials where we procured 76,000 kilograms at 754,000. And therefore, the actual price per kilogram will be 754,000. 754,000. You divide this by what here? 754,000. You divide by 76,000 to get price per kilogram. So there is no good reason for you to divide. Just leave this the way it is, like that. And then the AQ stands for actual quantity of materials than what here purchased. Actual quantity of materials purchased, yes. Actual quantity of materials purchased, of which we actually, from the actual information, we actually purchased 76,000. So ladies and gentlemen, having gotten that, come and give us the material price variance. So in brackets, what do we have? We have our standard price, which we already have here, which is 10, minus the actual price, which will be 754,000 divided by 76,000 times the actual quantity that we have here, which is 76,000. Now, using your calculator, what do we have? Somebody there. Using your calculator, this is what we have. We have open brackets. We have 10 minus 754,000 divided by 76,000 equals whatever I get there times 76,000 times 76,000, which will end up giving me 6,000 positive. Positive to us here will be what here? Will be favorable. Favorable, why? Because we did a saving. We did a saving because this figure has to be smaller than this for us to get a positive figure. You can even try it with you. This 754,000 divided by 76,000 gives us 9.92. So you can see we had prepared to purchase these materials at 10, but we ended up purchasing them at 9. So we saved that. So that is it. From there, we go to the second one, known as the material usage variance. Material usage variance, I need a summary, a place to summarize my variances. So I've got a near material price variance as 6,000 favorable. So from there, we do the material usage variance. So usage variance, this one we're looking at difference between two quantities. What in this case here we thought we would have incurred minus what we actually incurred, multiplied by what here the standard price we monetize. So to get material usage variance, we are taking here the standard quantity minus actual quantity multiplied by what here? SP. So I would want you to write there very importantly that this capital SQ. Capital SQ stands for standard what here? Quantity. Capital SQ stands for standard quantity for actual production. Standard quantity for actual production. Standard quantity for actual production. So please underscore the words actual production. Underscore the words actual production. If you look at your standard cost card, the standard cost card which is given up here, you can see the materials required were 2 kilograms. But this is for 1 unit. So I need to come and talk over 2 per unit times the number of units here that were actually produced. So it will be 2 times the number of units here that were actually produced. And if you look at the actual information, the actual production here was 36,000. So then 2 times 36,000 gives us what here? Gives us 72,000. That is a standard quantity. So therefore, our material usage variance here will be equal to the standard quantity, that is 72,000, minus the actual quantity of materials that were used. The actual quantity of materials that were used, the actual quantity of materials that were used. If you look at the question here, the standard quantity of materials used, that we are okay. The actual quantity of materials, actual quantity of materials was 76,000 kilograms. So we have here minus 76,000 multiplied by the standard price, multiplied by the standard price per kilogram. Standard price, of course, go up there. You'll be able to see the standard. So we have our materials, ladies and gentlemen, our materials, standard materials 2 kilograms at 10 per kilogram. So times the standard price per kilogram here times 10. So then this one here will give us what figure? You can see this is 4. So 4 negative times 10, that gives us 40,000 negative. But you see, I can't say negative, so I'll write 40,000 adverse. So the material usage variance in my summary here, material usage variance will be 40,000 adverse like that. Now, ladies and gentlemen, remember, when you're interpreting these variances, we have like here a situation where we had planned to use 72,000 kilograms. Our standard usage is 72,000, but we went ahead and used more. We actually used more. So of course that cannot be good for any company. That automatically is an over usage. It's a wastage. So it becomes what here? Adverse. It becomes adverse. It becomes adverse. So ladies and gentlemen, I would want to take this opportunity to encourage you to share, our stuff online. For those of you who are watching us through YouTube, please subscribe to our channel. Subscribe to our channel. Simply subscribe and ensure that you touch on that bell so that in the future, whenever we upload our videos, you will automatically be notified by YouTube for you to check on the video that we have just put up there. And we really thank you very much for your support. And don't forget, for mastery of this content, proper mastery of this content, we really encourage you to purchase our classes. We have live classes which you only purchase for 200 shillings. Live classes that you purchase for 200 shillings per lesson. And then most importantly also, ensure that you buy these books. They are RCM OTR books in the market. You can get them all over in these supermarkets or other bookshops, or you call us. We'll simply be able to give them to you. Now, that takes me to the next variance, ladies and gentlemen. That takes me to the next variance, ladies and gentlemen, called labor. Because you're following this particular question here, we've been able to get the materials, both of them. Now we are going to labor. So for labor, what do we have here for labor? So labor, we have got two types of variances. Under labor, we have what we call the labor rate variance, and the labor efficiency variance. So labor rate variance, difference between two rates, standard rate minus actual rate. Standard rate minus actual rate, that is labor rate variance. Remember, this will be a variance for 1 hour. So come outside and multiply with what here? Actual hours. Multiply with actual hours. So don't forget that this SR is standard rate per what year? Per hour. Standard rate per hour. So like in this question, have they given us the standard rate per hour? Check. In this question, have they given us the standard rate per hour? Check. From our standard cost card, our standard rate of labor, 3 hours at 24. I'm interested with this 24 per hour. So the standard rate per hour is 24. And then we have AR. AR in this case here is actual rate. Actual rate per hour. 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 Go to the actual information. Go to the actual information. So actual information, what do we have? We have our actual results. You can see under labor, we paid 56,000 for this number of hours. But I want the payment per hour. So the payment per hour will be 56,000. Divide this by what year? 114,000 hours. 26,000 divided by 114,000 hours for us to get the actual payment per hour. I hope you're able to follow. And then, of course, we have AH. AH stands for actual hours, which are 114,000 like that. So please come and plug in these figures here. So for you to be able to get the labor rate variance, what do we have? We have the standard rate. The standard rate is 24 minus actual rate, 56,000. Divide this by 114,000, multiply by actual hours, which were 114,000. Then this one at the end of the day will give us what figure? It will be 24 minus 56,000 divided by 114,000 equals whatever I get times 114,000, which will give me 80,000 positive. So positive means what here? Favorable. Positive means that the actual rate was lower. So we saved. we saved. So that is okay. Now, after that, ladies and gentlemen, we'll come and talk over the labor efficiency variance. Remember, we said labor, we have got two of them. We have a labor rate variance, and then number two, we have what we call the labor efficiency variance. And of course, without wasting time, remember labor efficiency variance, what do we have? Labor efficiency variance, ladies and gentlemen, we happen to remember Mr. Shah, this community of Kenyans, which happen to be very efficient in terms of how they run their businesses. Indians, basically, they are very efficient because most of the business that they create are able to, leave them, or rather, we leave them here. So they don't have issues. We'll get to, for example, Kirinyaga Road, and they get an Indian's shop that has been there for over 200 years, meaning that they are very good in terms of setting up controls, etc., etc. So in short, anytime you see any efficiency variance, always remember my friend from that community called Mr. Shah. So, and then now we have here times what here? The standard rate times the standard rate, So we have here standard hours, this SH stands for standard hours for actual production. Standard hours for actual what here? Production. Standard hours for actual production, which in this particular case, the standard hours, if you look at this question very well, the standard hours from the card, the standard hours are here. We are talking of 3 hours. 3 hours. So, but remember, this is for only 1 unit. So 3 hours for 1 unit, 3 hours for 1 unit. So if it's 3 hours for 1 unit, I need the standard hours for the actual production. So come and multiply this with the actual number of units here that were done what year, that were produced. So the actual production in the period, the actual production, the number of units that we produced in this period, the actual production was 36,000. So we have here 3 times 36,000. So 3 times 36,000, that will give us 3 times 36,000. That gives us 108,000. 108,000. 108,000. So ladies and gentlemen, having gotten that, then our labor efficiency variance will be equal to the standard hours that we have here, which are 108,000, minus the actual hours. Actual hours, we got them here. They're 114,000. Times, I'm following this. Standard rate per hour, we got the standard rate per hour as 24. So there we are. So 108,000 minus 114,000 equals times 24, which will end up giving us 144,000 negative, which is what here? Adverse. So we have our summary, don't forget. We have the labor rate variance, which gave us 80,000 favorable. And then we have the labor efficiency variance, which has just given us 144,000 adverse, like that. Adverse. So those ones in this case here who are, ladies and gentlemen, watching us on Facebook, don't forget to share. Remember, here we are able to sell to you. We are able to sell to you lessons here. 1 lesson at 200 shillings. You simply call the number that you're able to see up there on your Facebook. You call that number that you're able to see there on your Facebook. We'll be able to sell to you these lessons at a very cheap price. And then number 2, we are selling these books. These books, they really complement the videos. Please ensure that you acquire your copy by calling us. Give us a call. We shall be able to sort you out. Okay. So please don't forget to share this particular live cast. And also it's important for us to be able, for demographics purposes, to know where you're watching us from. That will really help us to create some wonderful strategy for those Kenyans who are living in far areas from Nairobi. So please tell us where you're watching us from, those ones who are watching us on Facebook. on YouTube. Just tell us where you're watching these videos from. That's very important for us. You may not be able to know, but for us, that is key. Tell us whether you are able to hear us loud and clear. Loud and clear. Talk to us this morning. Talk to us this morning. So remember, I'm following this particular question. This question here, where they have told us to calculate the applicable variances. We calculate the applicable variances. So I've been able to calculate the material variances, 2 of them, labor variances. Now we attack the sales variances. So right there, sales variances. So sales variances, we have got 2 of them. We have the sales price variance, and then number 2, we have the sales volume variance, sales volume variance, sales price variance, and the sales volume variance. So we start with the first one, which is the sales price variance. How do we get sales price variance? So difference between 2 prices. We have difference between 2 prices. So we have what we call the standard selling price, minus the actual selling price, and then outside here we have the actual quantity that was sold, actual quantity sold. So ladies and gentlemen, the standard selling price in this question, of ours, we can see the standard selling price is 136. Minus the actual selling price, actual results, we can see under the actual result note 2, the actual selling price was 134. The actual selling price was 134. Come and multiply this with the actual quantity that was sold. So the actual quantity that was sold, the actual production and sales, we can see 36,000 there. So 36,000. So then this one here will give us what figure, ladies and gentlemen? This is 2. 2 times 36,000 is 72,000. It's positive, but this has to be adverse. The sales price variance is 72,000 adverse. Remember, the exceptional variances, those variances which are exceptional, which have to be interpreted in the opposite way, are 3. We have a fixed volume variance. Number 2, we have fixed overhead capacity variance. Number 3, we have all sales variances. I'm repeating again, and please write them down, the exceptional variances. So the first one is the fixed overhead volume variance. Will be interpreted in the opposite way. Number 2, fixed overhead capacity variance. Number 3, we have all sales variances. We are saying that they are exceptional simply because anytime you get them, for example, like now this one here, we have gotten it to be positive. Instead of it contributing towards our profitability positively, it will be eating into our profits. Our profits in this case will be reducing, and I can explain why. Imagine you had set to sell your goods at 136, and then you end up selling at 134. I mean, the standard price is 136. And then your customers have come bargaining. You've been able to actually sell these things to them at a lower price, at 134. There is no way you can be happy. That is an adverse variance. So, and we don't want to be going to this particular kind of thoughts. What we're supposed to know is that there are 3 types of exceptional variances. We have, in this case here, the fixed overhead volume, fixed overhead capacity, and then we have sales what here? Sales variances. Please write that down. It's very important. So the last one, number 2 here, is the sales volume variance. Sales volume variance is quite an interesting one. Sales volume variance is an interesting one. It's difference between 2 volumes. We have budgeted volume minus actual volume. And then outside here, we have what we call the standard contribution margin. Because what will be put outside here depends on what is to be reconciled. This question asked us to reconcile budgeted contribution with the actual contribution. So here we're reconciling contributions, and that is where we have to put standard contribution margin outside. Otherwise, if the examiner told us to reconcile like profits, then I would have put standard profit per unit, standard profit per unit. So the first thing that you need to do is to come and compute for us the standard contribution margin. Remember, this is price minus what? Variable cost. If you've done your CVP very well, it is price minus variable cost. So in this question, from the standard card, you can see from the standard card. From the standard card, what do we have? We have our selling price of 136 minus our, sorry, this bracket will be there. So it should be 136 minus bracket here, variable cost. We have two of them, materials and labor, where you can see variable per unit is 20 plus 72. So then this will give us what figure at the end of the day? We are talking of 136 minus open bracket here, 20 plus 72 close, which will give us 40 what? 44. And then now come and plug in, give us the figures here. So sales volume variance will be equal to, we have budgeted volume. They were budgeting, ladies and gentlemen, if you look at this question very well, they were budgeting to sell 38,000. So budget 38,000. So I'm substituting here, budget 38,000 minus the actual volume that was sold at the end of the day. The actual volume sold at the end of the day, the actual volume, actual results, actual volume, 36,000. So the actual volume is 36,000 times the standard contribution per unit, which is 44. So we have here 38,000 minus 36,000 equals times 44, which will end up giving us 88,000 positive, but because it's a sales variance, this will still be called what here? Adverse. This will be called adverse. It's a positive variance, fine, but because it happens to be a sales variance, it has to be interpreted in the opposite way. It has to be interpreted in the opposite way. It has to be interpreted in the opposite way. Very good, very good. So I hope you're following. For those of you who are watching us live on Facebook, don't forget to buy our online video classes per subject, 200. One lesson, just 200 bob. Call the number that you're able to see up there. Call the number up there. Call the number up there. Call the number up there. We'll be able to sell to you our live classes, sessions at 200. It can't get that any cheaper, I mean. And then number two, don't forget to buy our RCM's revision kits. Don't forget to buy our RCM's revision kits at 1,100. 1,100. Now come here. So what you want to do, ladies and gentlemen, is a reconciliation statement. This question had asked us to reconcile. The question had asked us to reconcile. The question had asked us to reconcile. So a reconciliation statement. A reconciliation statement. It's also called an operating statement. So what are we reconciling? Budgeted contribution to the actual contribution. So budgeted contribution, remember the standard contribution that we got. This was 44 times the number of units here we were budgeting to produce. Number of units we were budgeting to produce, number of units which we were budgeting to produce, budgeted contribution. The budgeted contribution, ladies and gentlemen, or rather budgeted production, the budgeted sales was 38,000. So this one here times 38,000. So please give us a figure. So we have 44 times 38, 44 times 38,000, which will end up giving us 1,672,000. And then now in between, we have variances. In between the budgeted and the actual, we have variances, which fortunately, we have been able to list them here. So material price variance 6,000, favorable. We have material usage variance 40,000, adverse. We have labor rate variance 80,000, favorable. 80,000, favorable. We have labor efficiency variance, which is 144,000, adverse. We have the sales price variance, which gives us 72,000, adverse. And then we have lastly the sales volume variance. Sales volume variance is 88,000, adverse. 88,000 adverse. So please come and combine everything. You transfer there. So we have 6,000 plus, of course, whenever you see a device, you know it's a negative, so you put negative 40,000